Hello, in this video, we'll see more about futures. So before going through this video, watch my earlier video of basics of futures. In this video, we'll learn little more about futures. Okay, and this video is more of educational purpose for the knowledge purpose. Okay, so here I wanted to talk about few points. The first one is risk. Though we use little margin amount for trading, right, which is for trading futures, which is an advantage over stock trading, and we can make huge profits, and other way, in case of wrong speculation, we can bring huge loss too. So here that leverage factor is very tempting because you will be making lot of profit in case of your strategy is true. Okay, and but the other way it's a huge loss, so it is a risk factor, though the leverage is tempting, and this huge profit one, this is also tempting. Okay, so and wrong speculation, this is also comes under risk. And one more important point, okay, that everyone should be aware is that futures have lifetime, even options also. Okay, unlike stocks. See, if we consider current day, so we can see three futures for 3 months. And last Thursday of the month will be the expiry day, that all of you know. And that future cease to exist, and next month contract will become the current month contract, and 4 month one will become the mid month, and then they will add one more as a new one for the 4 month contract. So this goes on. So we should be aware of this fact that when expiry is near, whether we should roll over or just book loss or gain and exit from the position. The next point which I wanted to talk is basis. So basis means always there will be difference between spot underlying price and the future price, which we call as basis. So under normal market conditions, usually future price will be more than the spot, and obviously other two contracts above the current month will be higher. So this situation we call as Contango. These terms are used in commodity markets. And other way is also possible where future price is less than the spot price. Okay, spot price. So this we call as backwardation, and we say the market is inverted. And some people make use of this situation, inverted situations. Okay, so these terms are used in commodity markets, as I told, and these are just for the information sake. Important thing here is how to benefit from the trade. That's the more important thing. It's not like my way of presentation or anything, how much knowledge you gain from this. The next one which I want to talk is margin, which is very important. Okay, margin is some percentage of the contract value of the underlying, which is used to transact future. Okay, which is called as margin. So some important aspects one should be aware of margin is margin is variable. It's not a constant value. Okay, and we give some initial margin, right, which is set by the exchange, which will be blocked when we transact a future, buy or sell a future. So and one more thing is, in futures we can hold even short position till expiry, but in stocks we can't. And as this margin amount is variable on day to day. Okay, so depending on market movement, the profit and loss will be debited and credited on day-to-day basis. So which we call as M2M. People will be talking M2M profit. My M2M profit is so much. My M2M loss is so much. So it is mark to market. So the margin here is just like our account statement, where the loss will be debited and profit will be credited. And one more important is the initial margin contains two parts, span margin and the exposure margin. Span margin is set by the exchange and exposure margin is set by the broker. And broker will always keep a track on our margin when we have a position. In case of wrong speculation, that's our strategy goes wrong. It may happen. Our margin may start getting eroding and we get a margin call from the broker for restoring the margin. And the broker has all right to close our position if required. Okay, if we don't meet their margin requirement. And there's one more thing also, this span margin is more important. Okay, here also if this gets eroded and if this starts getting eroded, becoming less to some percentage, the exchange will put a penalty on us. So we should always avoid it and keep a track of the margin. This thing was mainly done to avoid defaulters. So there will be like in case if everything goes loss and that loss will be profit for the other trader, right? Which exchange has to give, and if this person is not giving the loss, then it's very difficult. So this facility is to avoid defaulters. In Zerodha, we have a margin calculator which you can see. You can see for the features how much is the span margin, how much is the exposure margin and all. Okay, and let's recap. So we have already talked about trading features and basics of features video. Just to recap it, always there will be 3 contracts and current month contract being a more liquid. And we talked about hedging with futures, nifty futures, and nifty futures are the most traded contracts. And we can do intraday, overnight future trading, and no need to hold till expiry. Always maintain margin for the active future positions and keep a track of it. Okay, and expiry of that particular contract is the final day that we can trade on that contract. From next day it will cease to exist. Day trader can have a great profit from trading futures, but risks are substantial. And one more important thing I want to tell is, no one can anticipate market movement 100% every time. We might get wrong sometimes, and that sometimes should not become many times. We should be aware of that, and we should always keep this in mind and control our emotions while trading. Also, more important thing is keep your enthusiasm while trading. Okay, these losses will happen, gains will happen. We should not leave our enthusiasm when trading. Okay, so happy trading, and we'll talk more about other things in our next videos. Thank you.